Class, did you know market psychology is the driving force behind every winning trade? You're making incredible progress. Each step brings you closer to trading like a pro. My name is Michelle, and today we'll explore the different types of analysis traders use to make informed decisions. Ready to trade smarter? Let's go. Trading without analysis is like solving math without a formula. You might get an answer, but you won't understand why. Analysis gives traders clarity, control, and confidence. It turns guessing into strategy. Successful traders rely on market psychology to understand what truly drives price movements. Behind every price move lies human behavior, fear, greed, and market sentiment. To make informed decisions, traders use two main approaches: fundamental analysis and technical analysis. You've been introduced to them both before. Now it's time to explore them in more depth. Fundamental analysis helps traders evaluate a company's financial strength by reviewing its earnings, assets, debts, and market position. It gives a clear picture of a company's value and long-term growth potential. Traders first ask, is the company increasing in revenue and profit? When sales and profits rise steadily, investors take notice, and rising stock prices often follow. Next, traders look to see what sets a company apart from its competitors. Strong brands, innovation, and leadership help create lasting growth and profitability. It might be a strong reputation, innovative products, or a dominant place in the market. Those advantages often help a business stay profitable and appealing to investors over time. Traders watch the economy to understand how it affects a company's growth, for better or for worse. For instance, when interest rates rise, people spend less and businesses earn less. But when the economy is strong, businesses often grow faster and profit more. Now that you understand how traders evaluate a company, let's see what you've learned. I'll ask a few quick questions. Choose the best answer from the options on screen. Let's think like traders. Here are 6 key factors, but be careful. Some don't belong to fundamental analysis. Listen closely. Chart patterns, economic conditions, revenue and profit growth, competitive advantage, price momentum shifts, and trader sentiment. Which of these truly belong to fundamental analysis? Take a moment to decide. Let's see which factors actually characterize fundamental analysis. The correct answers are number 2, economic conditions, number 3, revenue and profit growth, and number 4, competitive advantage. These reveal a company's real strength and long-term potential. The heartbeat of fundamental analysis. Great job if you got them all right. Now that you know how to study a company's value, let's move on to technical analysis. This is how traders read charts to spot market trends and understand how prices move. Technical analysis focuses on price charts, trends, and patterns. Instead of looking at financial reports, traders study market behavior to decide when to enter or exit a trade. It's all about timing, understanding when the market is moving and why. Every price movement in the market reflects changes in supply and demand. Technical analysis helps traders read those movements and predict future trends with greater confidence. You're taking a monumental step forward by learning how traders evaluate both companies and markets. Fundamental analysis helps you see a company's true value, while technical analysis reveals how prices move and why. Next, we'll take it even further. Exploring technical analysis, the primary tool traders use to analyze price action and profit from market movement in either direction.
Great work today, traders. And big shout out for Michelle for holding down the class while I sat in the back taking notes. Don't worry, I'll reclaim my chalkboard soon.
Thank you, Professor. Before we wrap up, don't forget your quick start guide. It's your toolbox to trade smarter. And if you're just joining our classroom today, I've got something important to share. We know this is where trading starts to get exciting, reading charts, spotting trends, the meat and potatoes. But if you skipped lessons 1 through 10, you missed the why behind every move. Without that why, emotions take over. You close too soon, hold too long, and profits slip away. Skip the guesswork, learn the why, and trade smarter.